Hey everybody, how's it going? It's Spencer Gray from Gray Capital. I just want to do a quick update of kind of where we are at a national level with rent collections across the United States. Now, there's a lot, still in motion. We're still early throughout in this recession, in the coronavirus 19 pandemic. But still we have to go off of what we see today, what the numbers are telling us, and then try to anticipate what's coming because we do have some bumps in the road. Let's not kid ourselves. We're not out of the woods by any stretch of the imagination, but we do have some really good news. And we've seen this anecdotally from our own portfolio. We are invested in a portfolio of over almost 9,000 multifamily units. We also invest in medical office buildings. But so the National Multifamily Housing Council, they're one of the leading trade organizations in the multifamily apartment industry, and they've been doing a really great job in tracking rent collections. And so let's take a look and see where we are. So you can see from June 1st through the 27th, 94.2% of all rents were collected. And now this is over a sample size of, I believe, a little over 11 million apartment units. So this is not, just a small, sample. This is a pretty wide selection of the industry itself. And it reflects, so it's 11.1 million. And this actually reflects what we've seen in our own portfolio. Last week, we actually reported our highest level of occupancy over the past 4 years to date across our entire portfolio. Now, I don't know if that's a combination between residents not wanting to move, if they're happy with where they live, they'd rather not have to go out there and try to find a new place. Also, the decision time, the sales cycle has shortened. People who are looking to lease an apartment, when they come and they tour, they may be touring one or two properties. They're not going around and touring every apartment in the market. When they see something they like it, they tend to sign the lease and try to move in. They're not trying to get around and test the market as much as they once used to. So if we go into the data a little bit further, and you can check this, they keep it really well updated. nmhc.org / we'll just Google NMHC rent tracker and it'll pop up on one of the first results in Google. So then this is comparing 2019 and 2020. You can see we're a little bit lower compared to 2019. I mean, with a worldwide pandemic and in the middle of a recession, you'd assume that there would be a little bit of a difference, but it's really on the margins and it's right within the standard deviation. So April, we were bracing for a worst case scenario in April. We thought collections may be down to 70%, 80%. I mean, we were at the start of a global pandemic. We were reading reports that there may be 30% unemployment. Now, that never materialized to a full extent. I mean, we did get some very high unemployment, closer to over 15%. Luckily, that number has come down. I think it's closer to 11% right now, but we have seen some people re-enter the workforce, which is pretty positive. But we are trending the right direction. So back in April 2020, they tracked 91.7. In May, 93.3. And then in this past month of June, we're at 94.2. And that compares from June of last year at 94.7. So, we're 5 basis points of a difference, and that's over the entire industry, the entire country. We're tracking a little bit better in our markets. We feel like we're in some better markets. We know we manage our assets better than your average apartment operator. So that's not surprising to us. But for the industry itself, this is great for people who are, currently invested in apartments, for lenders, the industry in general. And my thought from the beginning, and this is when we had no idea where things were going to go, is that if we are able to get out of this crisis relatively unscathed, and there will be some people who aren't able to get out of it, but if our company, our firm, our assets, if we're able to not just survive, but actually thrive through the process and get to the other side, that's going to be an excellent case study, not just for our firm, but for the entire multifamily industry, the multifamily thesis in general. Because apartments, they've been known to be recession resistant, hedges against inflation. And, we're not seeing the inflation yet. Oh, I think that may be in the next coming months or year when the Fed and Congress, I mean, trillions of dollars have been created over the past several months. But we always hear that apartments are relatively recession resistant. There's inelastic demand. People still need a place to live. And even though that, people maybe in Class A properties may be moving down to Class B, but you also have individuals who were living in homes who may be selling their homes, they may be moving, they're moving down to Class A. So there's a shift, homeowners to Class A to Class B to Class C, and Class C to Class D, which we don't operate in that sector. But that was the idea, and that's what we saw in the last recession in 2008. But in 2008, we were in a completely different environment. We were oversupplied. We had too many units. The lending was completely different. It was specifically a housing crisis. Not that lending in multifamily was the cause of it. It was obviously related to subprime mortgages, the bundling of securities. You know the story. You've seen the movie. But we're in a completely different environment in economic situation right now, where we have a complete undersupply of housing because that shock from the last recession got so many builders nervous, and we just didn't start building the way we used to. And that's been ramping up, and we have been meeting supply and absorption have been in more or less equilibrium for the past year or so. We were on track to deliver more units than was in demand in the luxury sector this year. I don't know if that's going to be the case anymore. And so kind of looking forward into the future, trying to see kind of the bright side and the silver lining in all of this. Not that we were facing potential oversupply, but we were bumping up to being, fully supplied and absorbing all of the new units that are coming online. Now with the slowdown in construction, that's going to add resistance to new supply, and that imbalance is just only going to increase. Now, that's really only related to the Class A, the luxury market. When we're talking about Class B and Class C, the imbalance is huge, and that's where we see an incredible amount of opportunity. But in conclusion, so far the numbers that we have are looking very, very positive. We're at 94.2% collections for the month of June, and I do have to mention, as I said, we're not out of the woods yet by any stretch of the imagination. At the end of the month, the extra $600 in unemployment insurance is going to run out. Now, there's talk of it being extended. There's talk of additional stimulus payments, but let's not count our chickens before they hatch, right? We have to assume that that's not going to happen. And without a doubt, this extra stimulus, this extra government assistance has certainly allowed just any resident, any American, if they're trying to pay their rent, they're going to have the ability to do so if they are unemployed with that $600 extra dollars. Remember, that's on top of other unemployment benefits. In the markets that we're in, primarily the Midwest, our average rent is closer to $850. And so if you're receiving $2,400 a month in extra unemployment insurance, that $850 is not a problem. So, but when that goes away, what is going to happen? That's the next thing that we're looking for. We're watching and waiting. And we're also going to see if the government steps in and makes any kind of changes, extends that. But you know what? We can't keep kicking the bucket down the road to some extent. This is it's a natural phenomenon. It's a pandemic. You can't control it. But shutting down businesses is also a government created problem, I would say. And so I think the government does have somewhat of a responsibility to assist those. And I do like seeing them helping individuals out directly rather than corporations and banks and entities. Not that you don't need to grease those wheels as well with interest rates so low. But I feel like those direct payments, I think, is a much better solution, because if we kind of stop the bleeding at the source, at the individuals, I think that solves a lot of the problems. And I'm not a big fan of government intervention in general, but I think a lot of this is a government-created problem, and they have the monopoly on this situation. So they are one of the ones that can help us get through this. So I'm curious what you think. Do you think that the end of the July, when unemployment insurance, is it going to be just absolutely horrible? Are we going to be in the middle of a storm? Is the virus going to pick up? And how's your portfolio been doing? What are you thinking about? Are you looking at getting into the market? Are you still going to be kind of on the sidelines waiting to see how things will play out? I can understand both sides. I see a lot of opportunities in the market right now. If you're a long-term investor, I see inflation picking up. Even with all the disruption in technology and the deflationary forces, I can't see by expanding the money supply to such an extent how we don't see some pickup in inflation. And the beneficiary of that is going to be real assets, hard assets, especially multifamily assets where you're releasing the property every year, and so you're beating inflation. So they're excellent hedges against inflationary pressures. So, we want to take advantage of that now while we still see some relatively good buying opportunities. But at the same time, once forbearance burns off eventually and we may see some distressed opportunities, that may not be until 2021, late 2020. I know a lot of investors who are waiting on the sidelines until 2021 to see where the chips will fall. So let us know what you think. And if you're not receiving our weekly newsletter, I'm disappointed. So go to greatcapitalllc.com, click the sign up for our newsletter button. Every Thursday morning at 8:30, we deliver a concise report of the newest news articles, research reports, new data that's coming out throughout the multifamily industry. We also touch on some other commercial real estate asset classes, the economy, but with a direct focus on multifamily investing. So if you're not signed up, go to Great Capital LLC, click the button, sign up. And if you're interested in what we do at Great Capital, have at it, go to the website, and it's all there. So I'm Spencer Gray, president of Great Capital. I appreciate you watching. I hope you learned something. If you weren't familiar with the NMHC tracker, check it out. Again, I would just Google NMHC rent tracker, and it'll pop up. All right, have a good day. Thank you very much.